Hello, Port St. Lucie, and welcome back to the Port St. Lucie Mortgage Broker channel. Today we have returning guest, Realtor Mindy Hackett from Berkshire Hathaway. Hi, Mindy. How are you doing?
I am excellent today. How are you?
I am ecstatic that we are talking about first-time home buyers. That is, I love that topic. That's kind of why I do what I do. I'm helping people that don't know what they're doing, and for the first time, hopefully get them into a house. So I appreciate you having this conversation with me.
Absolutely. First-time buyers are very near and dear to my heart because they've always been my most loyal clients, and they've always been, um, because we teach them so much and we're there for them the whole way, and we really help them understand everything, and they appreciate that. And a lot of my referrals come from first-time buyers that I've helped, and I love helping people, and being able to give them all the knowledge that I've acquired, and to help everyone make the best, most informed decision for them. So I've always loved working with first-time buyers. Even now, after 18 years, I still love it.
Yeah, and it feels less transactional and more emotionally involved and educational, where somebody is buying an investment property, they just want the numbers, they just, kind of go through the process. But
Right.
the first time home buyer specifically, the young family or even the individual purchasing the home and walking them through that process, they don't know what to do next. And, you're like the guide, and it makes you feel good. It makes us
Oh, yeah.
feel good
I
for
mean, I
what
still
we
care
do.
very much for my investment buyers and all types of buyers. I
Oh,
care for them very
absolutely.
much too, but it's different. It's you're a big part of their one of the biggest decisions they ever going to make in their life, and that's really special.
It is. It is. So, all right. So I know we're going to touch a lot of topics that will affect first-time home buyers. The reason I wanted to actually we talked about creating this video was because we're just a month out from the Florida Hometown Heroes program rolling out, which rolls out July 1st. For
Hmm.
those that don't know the program, kind of simplified version of it is that the state gives up to gives 5% up to $35,000 that could be used for down payment and closing costs, and it's on a silent second, which I'll kind of explain that through the video at some point. And it helps, especially again for the first time home buyer that may not have all the money that is needed to purchase that home. So we're getting a lot of people that are starting to inquire. At least I am, that's starting to inquire and wanting to find out about the program and what other options there may be if not that program. So again, we'll touch on that, but I'll let you take the floor and kind of give the audience a little bit of information on how you help your first time home buyers.
Well, first of all, I know we're going to get into this in more detail later, but one of the first things I tell people when they do ask me about the zero down loan programs, no matter what they are, is to have a conversation with the lender right away, because sometimes it might sound like a great idea on paper, but if the interest rate is half a point or 1 point higher than a regular loan, it may be to your advantage to do a regular FHA loan and ask for closing costs instead, or just come up with the money, because it will drastically affect your payment. So it's really important to get with a mortgage broker first as a first-time home buyer, um, to go over all the options and to determine what's going to be best for you.
Yeah,
Um,
it's not
that's
free money.
obviously
it's
right.
it's it's not free. Well, it
No,
could be. We'll touch on that, but generally speaking, nothing's for free in this world,
no,
and it may come with the higher cost throughout the first mortgage, maybe with a higher interest rate, and usually you got to pay it back somehow. So if
yes,
you have the funds, you might want to at least find out which one would better benefit you to meet your goal. So
right. And even if it's something that you're thinking about a year from now, I think that it's best to get with your mortgage broker immediately, um, as early as possible, because sometimes there are things that come up that you don't even know are on your credit report. I mean, you could have a 720 credit score, but maybe there's some weird thing lurking in your credit history that you weren't aware was still there, or, you know, sometimes weird stuff happens. I've even seen like second loans that were paid off but not reported as paid off, and then you have to go down this paper trail to get that taken care of. I'm sure you've seen all kinds of scenarios like that. So it's
Absolutely.
obviously that wouldn't apply to a first time buyer, but as far as having a second loan that was already paid off, but there's all kinds of things that can be
So
creeping.
technically, I'll just technically you could actually be right, because a first time home buyer technically is only if they haven't owned a house in 3 years, and someone that
Oh,
may have
true.
bought
I
a
forgot.
house, and someone that bought a house 20 years ago, you know, they might have gone through, you know, a home 20 years ago or whatever, they sold or whatever happened, and now they're going to, you know, buy a home, and honestly it's like their first time, because things have changed, the industry has changed, right?
Right,
Requirements have
right.
changed. So
But anyway,
um
I think the best thing you can do for yourself is, even if you're thinking a year out, 2 years out, 6 months out, 3 months out, as soon as you're thinking about doing it, call Jamie or your favorite mortgage broker, and
or Jamie,
specifically,
yes,
and let
only
him,
him.
let him take a look at your credit, and let him tell you what you need to do to get yourself in a better position. And even if what that one phone call, let's say that phone call increased your credits, you're able to increase your credit score by 40 points in that year, right? Just because you did this ahead of time and got something cleared up ahead of time or whatever. Um, and so that could save you thousands and thousands of dollars over the life of your loan.
Yeah.
If you're good, you know what I mean?
And you have
Um,
time, sorry to interrupt, but you also have time to fix or improve your situation. So, you know, the difference between a 739 credit score and a 740 credit score may be 0.5% on or 0.25% on the interest rate,
yeah,
right? You know, and especially if you're at 699 and you could get that to 740, that's going to help you. You know, there's a lot of
right.
programs that are going to change the criteria, the requirements, the down payment requirements. You may qualify for the down payment assistant at 700, but not at 699.
Yeah.
So
Or another thing, there's a lot of common misconceptions like, oh, well, wait, I want to pay off all my credit cards down to zero before I apply for my loan.
I
Well,
get that all the time.
that could actually make your credit score drop 20, 30 points. There's a sweet spot for the amount of debt you're supposed to carry. And so what is it, 20% or whatever. So if you have a $4,000 credit card, there's a sweet spot where if you carry $1,000 balance, you can actually make your score go up. I don't know what the sweet spot is. You know what it is.
Well, on credit cards, generally speaking, it's not. You don't have to. I don't think you have to carry a balance. But where it affects you, and where I see it a lot, is if there's a credit card that you pay off, like a gas card, and then you go and close it, or it gets closed, or when
Mhm.
you pay off a car loan, those, you know, now you're closing an account. Now that account, if you paid it well, it might actually hurt your credit score that you close that card. And if you know, if it was an account that maybe, you know, had some previous delinquency issues, things like that, and you pay it off and close it off, that might improve. But knowing, you know, being helped or guided through that process with a professional is what I would recommend. And I get a lot of the calls like, hey, they're not, you know, from realtors, hey, they're not looking for a house now. When should I have them call them? I'm like, now. Like,
Yeah.
call now. Like, you know, now's the time to have that conversation, because there's a lot of things that are behind the scenes that the buyer might not know. And we touched on this a little bit on before we came on. But, you know, for FHA, there's a system called Cavers, and it might not even be on your credit report. It might be an old student loan that came off. It might be an old, you know, something, the IRS, something that you don't know about. And when we pull that system, and you're trying to qualify for an FHA, it's stopped. That has to be taken care of prior to closing.
Right.
And you know, if you're going to find out, you'll want to find out, you know, hopefully months before so you can take care of it. So.
Right. Or just there's other things too. There's so many little nuances that go into lending that even as a realtor, I can't even keep up with them all. That's why I often refer these questions to you. But you know, another example would be a car loan. Oh, I want to pay off my car before I you know,
Mhm.
go ahead and buy a house, right? Well, isn't it true that if you have less than a certain amount of time on your car loan left, that it's not counted against your debt to income ratio?
Yeah, generally speaking, if you have less than 10 months to go on the
Hmm.
car, it won't count against you. But again, it goes back to, should you pay the car off? And sometimes cash is king. In our world, in life, cash is always king, right? We always want to have cash, but in mortgages as well, because, you know, if you have $20,000 available, I would normally suggest, let's see where we could place that 20,000.
Right.
Maybe it's going to be on the down payment. Maybe it's on the closing cost. Maybe it's on that car payment. Maybe it's on the credit cards. You know, sometimes I get clients that, you know, I'll give you an example. Let's say they paid off, and I'll use this example, but they pay off $20,000 worth of credit card debt. And that monthly payment that they were paying on that credit card debt, again, made up, is $500. Well,
Hmm.
they had an $18,000 car loan that the payment is $1,000 a month, right?
Right.
And for qualifying purposes, I'd rather that money go to the car payment, because that takes away $1,000 debt. That makes it easier for me to help you qualify versus you putting that on credit card. So the point is that the buyer would never know, generally speaking, they won't know where that should go. And again, I don't tell anybody what they have to do, but I would tell them, hey, this, if you pay this off, it relieves $1,000, and, you know, I'll explain it to the buyer, the potential buyer, but they just don't know, so they try to do the best, but, you know, sometimes they shoot themselves in the foot.
Right. They think they're making a really good decision, and in all actuality, it might be hurting their chances of getting a loan. Or
Correct.
so I think it's crucial first step is to get in touch with a lender as far out as possible, get all your questions answered, get everything figured out, come up with a plan, and get yourself in the best position possible for when that right time is.
Yep.
So that's
Um,
number one.
yep. What's the
Um,
next step that you do for the first time home buyers?
so number two, well, a lot of people come to me when they think they're ready. So they don't do that crucial first step ahead of time. But when they are ready, you know, now they're calling you, right? And look, a lot of times things do work out great, no problem. You're qualified, no problem, and there are no messes to clean up, and that's most cases, right?
Mhm.
But the next thing to look at is, okay, well, um, what amount of money are we getting pre-approved for? But for me as an agent, and a lot of people don't think this way, but I do, is okay, so you're approved for this amount of money, but more importantly, what amount of money are you approved for per month, right? Based on your debt to income ratio, so that we can reverse engineer what properties are going to work and what properties are not going to work. But furthermore, let's just say, well, okay, you are approved for 3,000 a month, but you know in your heart that really the most you can afford to spend per month on your mortgage, taxes, and insurance altogether is 2,600. Otherwise, you're going to be making major sacrifices, and you know Billy doesn't get to play baseball anymore. You know, so you know we really need to look at what you're comfortable spending per month, not just what you're approved for, right? And
Their
reverse
personal
engineer it from
budget.
there. Yeah.
Yeah.
What are you comfortable with? And will you still be able to save money? Because we don't want to put people in a position where they're house poor, I don't want people to hate me every, 30 days when they're writing a check or logging online to pay their mortgage, so it's important to make sure that we're shopping in a comfort zone for you. Um, and from
I
that point,
actually, and before we move on, I actually had a client, I think it might have been a month ago at this point, that asked me, "Hey, how much do I qualify for? Whatever that number was, 500,000, whatever, 500,000." And they're like, "What was the payment?" I quoted the payment, and they're like, "Okay, so how much at this amount? Because that's my budget." And literally, it caught me off guard because I hadn't heard that in so long, where people actually are more worried about their personal budget, and they'd rather, I won't say this specific client, but that they would rather not purchase if it doesn't fit their budget. And that's a good thing, right?
yeah,
Like that's the right thing to do. Because it has to meet your budget regardless of, it shouldn't matter how much I qualify you for. That just tells you how much I could give you a loan for.
right.
The more important thing is how much you will actually feel comfortable paying every month, and for your lifestyle, and everybody's lifestyle is different.
Absolutely. So that's important to me, to make sure that you're going to be comfortable with what's going on per month. And then it also gives me a number to work with so that, I can reverse engineer, um, the monthly numbers based on what the insurance and taxes are going to be, and make sure that we're getting you in budget. So just for example, um, let's say there's a house that's technically within your budget, right? Um, but it was built in 1945 and the insurance is going to be $8,000 a year. Well, now you're out of budget. So we need to look at so before we go and look at this house that you're in love with online because it has so much style and it's amazing and you love the potential and whatever, the insurance might knock you out of there. So let's do the math and make sure we're keeping you where you need to be. um and or you might have a little bit more buying power on a newer home because the insurance is going to be less. So we need to look at those things and figure out what your sweet spot is and make sure that we're really only looking at homes that get you there. And another thing to mention too is that, well, maybe you would be willing to spend a little more per month on a quote unquote newer home simply because you may not be needing to save up money for a water heater, new roof, AC as quickly or whatever. So maybe you would spend a little bit more in that scenario. So we just need to have those discussions about your comfort zone and figure out, where the best place to put you is going to be.
I agree. Yeah. One of the techniques that I use, and I'm sure we've come across this, is where, hey, I approve the buyer for 400,000. Now that takes into account, I don't know, $600 worth of tax, insurance, and association, right?
Mm-hmm.
And if you're able to lower one of those, no association, hey, I found a home without an association, and your tax and insurance are 400, well, guess what? There might be room for you to increase the price range.
Absolutely.
So that, a lot of people think that price range that you get qualified for is kind of your budget, and it's really not. It has nothing to do with what you qualify for. You don't qualify for an amount. What you're qualifying for is the debt on that amount, that monthly debt.
Right.
Yeah,
and that's why I often don't like to go off of an amount of money that they're approved for, like a purchase price. I don't like to go off of that. That I always call you and ask you what's the monthly
yeah,
payment.
yeah.
What monthly payment are they approved for? Because I can tell when it's going to be an insurance outlier or a really high HOA or another thing. I'll go over with my buyers is the taxes. So even though the taxes might only be $2,000 a year right now, they're going to adjust next year. We're going to go on the property appraiser site and we're going to get on that tax calculator, and we're going to calculate what your taxes are going to be. next year and how that's going to affect your payment, your monthly payment.
Especially for those that are looking for their personal budget, to meet
Yes.
their personal budget. Because the
Yes.
qualifying, you're going to qualify with this year's tax rate, whatever that was, unless it's a new construction. But for that person that's saying, hey, I cannot afford, no matter, I don't care how much you qualify me for, I cannot afford a payment higher than $2,000. That's the client that I not only mention it because I mention it obviously and go over it with every client, but that's the one that you got to nail home and explain that tax is going to go up next
Right.
year. So,
well, I go over that with everybody. So I don't want any surprises on that one.
Yeah.
And the other thing to look at too is the community development districts that some of the planned unit development neighborhoods have, or gated communities or whatever, where they have an HOA fee. Some of them actually have very high CDDs in the taxes. I want to say, for example, Crosstown Commons, I believe, is over $2,000 a year. I want to say it's 2,100 or 2,200 a year extra in the taxes. Now their HOA fee is only $80 a month, but you're paying an extra almost 200 a month in taxes to live there. So and it's also important to have a conversation when we are looking at these types of communities. What are you getting for your money in your HOA fee? Is it worth it? And that's another thing to take a look at.
Condo's a big issue right now because of that, obviously.
Yeah.
Because that insurance, usually on the master policy of that HOA or the condo association, it's pushing all those prices up. So, and it might increase, which is a sad part. Where it's high now, and it could still increase from where it's at today. And that's something that you got to take into account. Hey, it's a nice condo, but you're paying $800 a month in an association. Are you really benefiting $800 worth of, could you buy a house or maybe a different condo? But yeah, you definitely got to do the math to make sure it makes sense.
It's funny because if you do go, let's say, over to the island where there's a ton of condos, excuse me, some of the prices of the units sort of do correlate to how expensive the condo fees are. So it's sort of like sometimes the higher the condo fees, the prices can be a little bit lower just because they take longer to sell. But yeah, I have seen certain communities have increases in inventory. Let's say condo communities that were built in the 70s who had a significant insurance increase over the past 2 years have had significant condo due increases that have caused a lot of people to sell because now they're over their budget. So,
and most likely at a discount because of the price of that HOA.
Right.
What is the next step? So somebody comes to you, they've been pre-approved, let's say, you get the monthly payment.
Now we have our budget and we have our expectations set and we're ready to look at houses. So, I think usually for me, the first 6 to 8 houses are really crucial because in that time, I really can pinpoint sort of what you like and what's important to you and what your deal breakers are and things like that, and just sort of I get sort of a gut feeling or an understanding of the style and what you're going for, and so that's great. I learn a lot about my people and what's important to them, but let's say once we do start getting where we're identifying homes, I was telling you earlier today that I don't like to do a lot of research before I go to homes because you can get there and all of a sudden just the floor plan's terrible. It might have the best pictures in the world and be the best location, but you walk in, it just doesn't work. And now you spent 20 minutes trying to figure out a bunch of stuff about a property, and it's not a good use of time.
And some houses photograph well.
Yeah.
I it's gotta have been just 2 days ago. A realtor called me and they're like, "Yeah, we looked at that house. The pictures were amazing. When we got there, it was not anything close to it."
Yeah, I've had that happen
I'm
several times.
like,
I've had that happen
so,
on some of my own listings too, where they just photographed better than they felt in person, you
and
know?
sometimes they don't photograph well. I still, I chuckle whenever go online and I see the realtor taking a picture and you can see the reflection on the mirror in the bathroom. And I'm like, really?
Well, that's just, uh,
Really?
I don't even know what to
Anyway,
say about that. I could go off and talk about that for 40 minutes,
yeah, let's
but
move on because that's,
I have
if you
seen
do that,
some
I apologize,
fun
but come
stuff
on.
in the MLS. One time I saw a backyard photo of uh there was a dog using the restroom in the backyard.
Oh my
Um
gosh.
and then there's this one, I remember this one time I was going through, I remember these specifically because I posted them on Facebook because I thought they were really funny. So one time there was an exterior front photo of a property back when, homes were really cheap. And it was like a colonial style house with big columns on a big piece of property out in Fort Pierce, but it had a lot of deferred maintenance. And on the photo, there's like someone laying down on the sidewalk in front of the house.
Oh my God.
Just weird stuff you see.
Yeah.
But that is not how I would represent my sellers.
No, no,
Um,
I don't
but
encourage that
anyway,
behavior.
once we're there and I see that, you're interested in a house and I can tell, um, while we're there, we'll dive into it, a little bit more and just take a look at, well, how old is the roof? How old is the AC? I'm going to walk around and look for deferred maintenance. I'm going to look up at the ceiling to see if I see any water stains. I'm going to look down to see if I see any water stains. Um, we're going to look at the property a
Your
little more.
your lending partner appreciates that. Thank you. Because
Yes.
the last thing we like to see is an appraisal come back with, a stain of water coming down the wall. And I'm like, really? Nobody could have told me that was that out there.
Well, look, how ridiculous would it be for me to let you put an offer on a house that and have you spend money on the home inspection for something that I could have showed you? And you know what I mean? That's ridiculous. I hate people to lose money on anything. So I like to go around and whatever is visually apparent. And I go to every buyer's home inspection for 18 years. There's maybe a handful I've missed for some reason, but generally I go to every one and I've learned so much and I know generally what to look for. Sometimes things get past me. I'm not perfect, but
But
you know, we,
you're looking, not that you're looking for issues, but you're looking for issues. I mean, you want to make sure that there's not something that gets past you, that
well, look, for
could come back.
example, excuse me, for example, roof age, right? If a home is nearing the end of its function, or I'm sorry, if a roof is nearing the end of its functional life, I'm going to tell you that right now. Because okay, so this is, for example, this is going to be up to the home inspector to determine how much life is left on this roof. If it's showing, this is from memory, and I could be wrong on these numbers because these things change frequently, as frequently as mortgage lending requirements change. But for example, I'm pretty sure right now companies want to see 5 years or more left on a roof, or they won't insure, right? So so there's a chance that based on the age of this roof, that might be an issue. So, if it does come up that way, can we ask for a credit? Yeah, but the seller doesn't have to give it to us. So are you prepared for that to be an issue? Would you be
And a
able?
future expense.
Yes. So those things are really important. Or an AC nearing the end of its functional age, um, depending on what home inspector, most of them put that they last an average of 10 to 12 years in their report. Some of them can last 20 years. You never know. Um, it could be 2 months, it could be 2 years, it could be 2 days, it could be 10 years. We don't know how long they're going to last. So, but knowing that this is nearing the end of its functional age, this could be an expense 2 days after you close on the house. Are you prepared for that? Um, and so, we like to just make sure that there's a little comfort zone there, for the buyer to know, you know, before we even go into the inspection, as to what state the property is in. And that's important. I also found out the other day, I'm pretty sure, and again, I don't want to be wrong here, but apparently water heaters over 16 years are a big issue for insurance companies down here in Florida.
I
So
did not know that.
yeah, that came up the other day. But you know, these things just change so frequently, and right now they're looking for so many reasons not to insure people here that
Or to charge more for it.
yeah, exactly. So you know, that is what it is. And you know, we'll have conversations too with my buyers. I really want them, while we're looking at houses, I go over with them information about what a wind mitigation report is, and hurricane protection, and how it can make your insurance less money if you have these items, and that these are the kind of discounts you can get on your insurance if you have every opening properly protected. If one opening is not properly protected, then you're not going to get the discount. You need full protection to get
Right.
this specific discount. And I'll go over with them what a 4-point is, what a wind mitigation is, and those items, so that they can understand when they do go ahead to get their insurance quote. Right now, I'm a very strong advocate for getting that done immediately and during your inspection period, because that can be a deal breaker. And again, I would rather have a buyer find out before we order and pay $700 for an appraisal. I want them to make sure that the insurance is in the range that they are approved for their monthly payment.
Yeah. Again, your lending partner appreciates you for doing that.
Absolutely.
There's too many times do we get, and I can't tell you how many times look, and I work with a lot of great people. So, but you know, we ask, hey, make sure that we get the insurance quote up ahead as soon as possible, right, on the front end. And sometimes it's funny. The ones that I get up front are always low. They're good.
Yeah.
It's that one that you didn't get. I'm like, oh my goodness, that's a problem. Like,
Well, it can literally be a deal breaker.
yeah.
And why would you want to find that out after you spent $500 on a home inspection and 700 on an appraisal, when you could have figured it out while you were spending that 500 on the inspection?
Yeah, I can't tell you how many deals went sideways, especially like maybe at the beginning of last year of 2023. That's when they were really clamping down on insurance, and it was a major issue. Now it's still an issue. The issue hasn't gone away, but we're all aware of it. So we're all, you know, kind of, it's like
Yeah.
walking on with mines, you know, that they're there. So you gotta be careful. All right. So, all right. So
I
you
just
go
want to
through.
add to that,
Sure.
you know, our industry is ever changing, right? So I'm a real estate agent, and I deal a lot with insurance agents and mortgage brokers, right? And you both have very ever-changing industries, right? And so sometimes, you know, it's difficult, because as much experience as I have, sometimes I do have to learn things the hard way. Um, just, you know, finding out about the um, water heater thing a few weeks ago, or, you know, I'm always learning, and there's no amount of experience that can make anyone perfect at this job. It's just sort of how you handle the hiccups and find a way to work through them. But
Yeah, there's
it's
no guidebook written.
yeah,
There's not a
no,
book that you could write that you could read, and it's like, oh, you got to watch out for this and that. I mean, it's ever changing. Like, you know,
every day is
so
different for me, and every
every
day I learn
house,
something new.
every
And
house is
and
different. Yeah.
yep. So go ahead. I'm sorry for
No,
interrupting.
I was just gonna say, so you know, you kind of help the client understand any expenses that they might have up front, make sure they get a quote, any future expenses that you might see coming down the pike for them, let it be a roof repair or a roof, you know, redoing the roof or whatever the case is. So so let's say they move forward. What's the next step? So they like it,
So
they're okay with, you know, moving forward.
now we're writing an offer. So I, unless it's something, um, let's say, for example, let 9 times out of 10, when I'm writing an offer, I'm running comps. Okay. And I'm running comps because I want to make sure that this property is going to appraise. So I put the same criteria that an appraiser will use into the MLS. I pull up the sold comps from the last 6 months. If there's a ton of sales that are similar, I'll narrow it down to 3 months. And then, I sort them by usually either square footage or price, depending on how tight my square footage is that I'm using for the property. Um, and try to find, the 5 most similar properties. And then I make my calculations and throw out the high one, throw out the low one, take the average, and there you've got it. So, and I compensate similarly in the same way that an appraiser would. So, I wear many hats. But I want to make sure the property is going to appraise before you spend your money on the inspection and the appraisal. So we know what to expect going into it. I mean, I've had very few properties not appraise over the years, and I think maybe 4, and 2 of them we were expecting. Um, so so that's really important. And then from there, we start going through the steps. And at that point, once we get under contract, I'm facilitating the transaction and making sure we're staying on time with all of our deadlines, and um, making sure that the buyer's deposit is never at risk, and um, by not meeting deadlines, and sort of facilitating the transaction. But at this point, this is where it sort of gets handed over to you primarily after we get through the inspection. And from that point on, I've had many people tell me things like, they asked for everything but a blood sample. And I tell people that, um, that, getting the loan is the hardest part. Doing, all that paperwork is really the hardest part.
Yeah.
And that's where it gets handed over
And
to
doing
you.
it, and I will say, doing it, and again, I get to work with so many great realtors like yourself because, you know, because we've worked in the past, and I try to let you know that I'm gonna go through that process up front with the buyer.
Mhm.
That way, when they come back with that contract, it's basically, us sending either the current documents. I might need an updated pay stub or an updated bank statement, but everything's been reviewed
Right.
prior to them going out. So it's so important for them to get that pre-approval process through,
Mhm.
so that way they don't have that painful situation where now they're scrambling for documents and everything's got to be picked through and things like that. After that contract is signed and they're under contract, it should generally be a smooth process, and that's what I try to make it for the buyers. And
Right.
um, and again, great realtors give that, give the heads up to the buyer, to their client, to ensure that they know, hey, do all the heavy lifting now, so that way once we're under contract, it's easy. So
Right.
um
The
all
other
right.
thing to mention is
Yep.
um a lot of first time buyers are getting FHA loans, and a lot of on an excuse me, on an FHA property, there needs to be certain criteria that are met as far as the condition and safety of the home. So occasionally, we do in Florida use an as is contract with buyer's right to cancel at their sole discretion during the inspection period, which is a great contract. It's a very fair contract to buyers and sellers because it doesn't obligate, it gives the buyer the opportunity to change their mind during the inspection period for any reason they can dream up and get their deposit back. And for the seller, it doesn't obligate them to make repairs or to give credits, but it gives them both the opportunity to negotiate and come to a happy um, medium where both parties can be happy. And oftentimes, we do end up negotiating repairs or credits. And the instance where we end up having to negotiate repairs is if something isn't meeting insurance minimum standards on the 4-point mitigation, or more likely on the 4-point, sorry. Let's
Right.
say the water heater's too old, or there's electrical exposed wires, or a double tap on your electrical or whatever. In order to get insurance, those things have to be repaired. And in order to get your mortgage, you have to have insurance at closing. So those things are typically negotiated and accepted by sellers to be repaired, as long as it's not dipping too deep into their pockets where they don't have enough money to handle a situation, the seller.
Right.
So, we may negotiate some sort of repairs, and if it's not an insurance or safety issue or whatever, then I typically prefer requesting credits over repairs, just because then at that point the buyer can pick their own vendor to make any repairs, and it's someone that they know and they trust, and they get to pick the warranty. And I think it's better for the buyer to get a credit. However, if we need to do it to close for insurance or FHA purposes,
Yeah.
that's just the way it is.
Yeah, and the sellers, they could, complain about having to pay an expense to sell a property, but the truth is that they don't, and it's a required, fix, let it be a water heater or leak or exposed wire or something like that. The chances are they're going to have to get it done or sell it, not through financing, because it's going to be
Right.
it's going to be an issue with any financed company.
Right.
They're not going
Any
to,
insurance issue, if there's an insurance issue where a property can't pass a 4-point, the only way to sell the property is cash at that point.
Yep.
Or a private lender, but who wants 11% interest? Well, I do have someone who's doing that temporarily to fix up a property, but we got it at a huge discount, etc. But yeah, so those issues are certainly important. And from that point, we just get it to close, and it's stressful, but once you're there, it's an amazing feeling for a lot of people to accomplish home ownership. So I love doing that for people. It brings me a lot of joy to do that for people.
Yep. Yeah, and again, it's nothing against the investor that we help, and hopefully it didn't sound wrong when I said, it's more transactional, but you don't have to hold their hand, right? Like, you don't have to hold their hand through that whole process, generally speaking, if they're experienced. But the first time home buyer depend on you. And
right.
we take that responsibility, very, very highly. I mean, we want to make sure that we take care of them, protect them from what they don't know.
Absolutely. That's so important to me, is having people walk through the process and not feel, because it can be overwhelming and it can be stressful, but at the very least, I want them to feel comfortable with the decisions they're making, and that they do I want to make sure everyone fully understands everything, that's important to me.
Is there anything else that we wanted to touch on? I know that we talked about the Hometown Heroes program. So before we jump to that, or down payment assistance programs, because I kind of wanted to make sure we touched on a few things there. Was there anything else, any other major step outside of, just getting to closing, or anything that you wanted to touch on?
Those are the most important. We've definitely covered the most important items. Obviously, there's a lot of small steps and small coordination things that go on with the title company and stuff like that. But for the most part, I think that these are the items that you definitely need a great agent to really fully educate you on throughout the process.
Okay. So going back to the Hometown Heroes. So again, for those that don't know or have, maybe they, there's a website, Florida. Do you know the website off the top of your head? It's Florida's Home.
FloridaHousing.org or something.
Yep. I have it on my favorites. So, but you could always get a little bit of information on that. The guidelines for the new program rolling out July 1st have not come out. I expect it to, there hasn't been any word that it's going to change. So I expect that to stay, if not the same, very similar. So it shouldn't change too much from last year. But I get a lot of questions. First of all, we're still in, we're recording this on May 22nd. So there's still a lot of people that are like, hey, I want to buy. When is that program going to be available? And, there's options now. And this is kind of what we talked about again before we started recording, was that there's options today that you don't have to wait for that program.
Right.
And we get a lot of questions regarding, like, how does that, do I have to pay it back? Things like that. So that's kind of the part that I wanted to touch on. So this is not only for the Hometown Hero, I'll touch on that, but also other down payment assistance programs, regardless if it's because you don't want to wait till July, or maybe you don't fit the criteria for July, for the Hometown Heroes in July. So I want to make sure that people know that there's other options outside of that. So
and there are income limits, correct?
Yes and no. So there are programs that do have income limits and some that do not.
Okay.
So that's a great question. That's one of the questions that I do get. So again, I don't want to go down every single program, because there's honestly probably hundreds of the programs, because there's a lot of lenders that offer that. But with a broad stroke, I wanted to kind of touch on a few. So income limits, it depends on the program, but some of them will have income limits, meaning that you can't make maybe 80% of the median income in that county. Some of them do not have any income limits. Some of them you have to pay back. So they're getting into that. There's basically, generally speaking, 3 types of down payment assistance programs. Okay, and again, this is including Hometown Heroes, but not only Hometown Heroes. The first one is repayable. So what the lender will do is give you a second lien on the property, and that will be a mortgage, let's say for the $15,000 or $20,000 that you need, and there's an interest rate attached to that, and a term. It could be 10-year term, 20, 30-year term, and you're going to be making a payment on that loan. So you're going to pay your payment on your first mortgage, and you're also going to be paying a payment on that second mortgage that was used for the down payment. The second one is a silent. The silent mortgage is similar to the Hometown Heroes, where the mortgage company will go ahead and put a lien on the property, but you're not required to make monthly payments on that mortgage until you pay off your first mortgage. Let that be through either refinancing the first mortgage, excuse me, or selling the house. So whenever you refinance or sell that house and that first mortgage got paid off, at that point, that $15,000, $20,000, or up to $35,000 on the Hometown Heroes will then be due. So if you're selling the property, they're going to take that money back at that point. If you're refinancing, then that you're going to have to refinance high enough to cover that cost for that loan, in addition to additional closing costs that a regular refinance might require for you to pay. So again, the first one's repayable. The second one's silent, that you don't have to pay. The third one is the forgivable. So this is the one that if I tell you, hey, we're going to give you a down payment assistance and we're going to forgive it, that sounds like the best, right? Out of the 3.
What's the catch, Jamie?
Going back to there's nothing for free. Generally speaking, those lenders will basically price their first mortgage higher. So as an example, let's say you qualify for 6%, they might end up giving you 7% on that first mortgage. And then after 5 years of you keeping that mortgage, they will then forgive that second lien. Okay. But again, it's not free, because if they might have given you $15,000, and during those 5 years, you may have paid an additional $20,000 to $30,000 in interest on that higher amount. So always keep in mind that there's nothing for free, and there's options. And that's why you want to speak with a professional, because I get people calling me and they're like, hey, I want the Hometown Heroes. I'm like, why that program out of the other ones? And they're like, what do you mean? Right? They don't know. So and that's okay. That's why I have a job, and I like that. I don't want, and I like that they might not know everything, and that's my job to educate them and show them there may be a better way.
Right.
But we want to just make sure that they know that the free one is not always free. And I wish everyone in my industry would, very clearly clarify that, because if it's, hey, it's forgivable, don't worry about it, it's good. That's kind of where some of us go astray, and I want to make sure that we take care of the buyer, the client's the most important thing.
So I think it might be really helpful if you could sort of run the numbers on a scenario to let people understand exactly how much that can affect their payment. So, for example, would you say,
So I have
I
my fancy mortgage calculator that everybody used to make fun of me because it's so big, but I'm
that is
ready.
fancy. All right, so let's say, what would you say the average price of a hometown hero? How many did you do a bunch
So
of them? Or?
no, we'll keep it simple. Look, I don't even want to assume what the rate's going to be at that point. So this is not, I'll just use make believe numbers.
Disclaimer, yeah, give a disclaimer.
These are not what the program will be. I have no clue what it's going to be.
So just
But
to make it simple, I would say let's take $400,000, right?
man, you read my mind.
And take today's rate and give us the principal and interest.
Okay, so I won't take today's rate. I'm just going to put an even 7, because every
Okay.
rate's different. Every client
Well, yeah.
will qualify for something different. So let's assume it's a
even
7.
when I Google what's today's average mortgage rate, it's always different.
Yeah.
On different sites.
Yeah. So on a 7% interest rate, your payment will be $26.61. Of that, $23.33 will be interest.
Okay.
If I'm
okay, but your principal and interest is $26.61 on that, right? Correct?
I'm sorry, repeat that one more time.
Your principal and interest would be $26.61.
Mm-hmm.
Okay. Now run it at 7.5.
Yeah, I'll actually go even higher. I'll even say 8%, because it's going to be more expensive on some of those programs.
Okay.
So on something like that, let's say it goes up to 8%, your payment's going to be $29.35, and the interest on that would be $26.66.
Okay.
So basically $333 difference a month in that scenario. So you get that, the difference in real interest is $333 times 60 months. That's $20,000.
Right. So I'm looking at monthly payment there. Your monthly payment would be $274 more per month.
Yeah.
So that's almost, I don't know, that's probably about $3,000 a year more.
Yeah.
That
But the bottom line, the actual interest. So without comparing the principal, because some of that obviously will go on principal, I extracted the principal out of it.
Mm-hmm.
So that second loan will cost you by itself $20,000 in that scenario.
Right. But what I'm saying is, let's look at our, just even looking at the increase in the monthly
Mm-hmm.
payment, right? So you're going to pay for let's say, what's 3.5% of $400,000, like 13 something.
14,000.
Okay, so $14,000, right?
Mm-hmm.
You're paying $300 a month for 30 years more for $14,000.
Yeah, well, if it's that, generally speaking, they won't go for 30 years repayable. So that would be usually for the 5 years. Oh, so you're saying if you keep that mortgage for that long?
Yeah, yeah.
Yeah, it could be. But just even if you go 5 years, chances are you most likely will refinance. Most mortgages pay off in 7 to 10 years is the average.
Mm-hmm.
So will there be some stragglers that last to 30 years? Maybe, but even at 5 years, you don't even have to go that far. They're going to pay, even in 5 years, they're going to already overpay it.
Right. So if it comes out to about, let's say, $3,000 a month or a year extra, right? So yeah, I mean, in about 4.5 years,
Mhm.
you've broken even. So
Yeah.
if you do have the money for the down payment, unless the interest rate's the same as a regular, it
Unless you need it, look,
yeah,
it really does satisfy a need. There's people that do need it to qualify and to purchase a home. So, um,
absolutely.
so
But if you don't need it, it's it's better not to take it,
yeah.
in my opinion. So I'd rather
Again, I always say, I learned this from my old boss I used to work with. Every scenario I threw at him gave me the same answer. It depends. It depends, because maybe they could use that money towards other things like paying off other debt, or maybe they need to save that money for a roof,
right.
or maybe they, so it depends. But I think, to your point, is that you got to have the conversation. You got to dig in. You got to break out the numbers. You got to show them. Every client's going to have a different situation. Every house that's being purchased is going to
Hmm.
be different. Some will need a new roof. Some, won't. Obviously, and other things that might have to get done. And if the client does have money, or the buyer does have money, then we could discuss options on how to better spend that money versus putting it down on the down payment. So, right.
Right.
So it might make sense to, in that case, maybe go with the down payment assistance program. But again, every situation, it depends.
Yes, absolutely. Well, and everyone has different needs and different
Yeah.
situations, but
Yeah. And again, and their situation might be also, their monthly budget might not be impacted. So for me, a $300 increase a month might be too much. I'm like, I don't want to take that on.
right.
But for someone else, a $300 increase would be like, yeah, that's a very small portion of my income. So again, it depends. And I think that's where we step in, and we're able to kind of extrapolate all that information and kind of show them different ways of doing it, and what options they may have. So
Just make sure that I think you and I both make it very important to make sure that people are making the best decisions for them.
yeah, perfect. So
So
um anything else you wanted to share, Mindy, before? I know we're pushing up against our time here, but anything else you wanted to add
no, thank you
before
for
we go?
doing the math.
No, I appreciate you again. I appreciate you taking the time to come on and give us all that great information for first time home buyers. Again, if you wanted to reach out to Mindy, her contact information is below. She, covers basically the whole Treasure Coast, and I'm sure other areas if you speak to her about that. And she's full of knowledge, so I definitely recommend you doing that. Other than that, but I'll go ahead and put that. Sorry about that. My phone was going off here. But other than that, hopefully you guys found some value in this video. If you did, and I always forget to ask this, but if you did, please don't forget to click that like and that subscribe button. There's also a little bell icon on the video. So if you click on that, you'll be notified when I release the next video. And I try to put out a daily video as well, with a little bit of information on inventory and the market and rates. And I also try to throw in an article or two on what's going on, or what's impacting the Port St. Lucie market. So other than that, Mindy, I appreciate your time. Thank you for coming
I
again.
appreciate your time and your knowledge as well. And
And,
thank you so much
and I
for having
appreciate
me
it. And
again.
thank you, Mindy. I appreciate you. And I'll talk to you soon.